Limited is considering two mutually exclusive project X and Y. You have been given below the net cash flows probability distribution of each project. Project X, Project Y. You are required to compute expected net cash flow of each project. Expected value, average is one and the same. Variance of each project, standard deviation of each project, coefficient of variance of each project. And then you need to identify which project do you recommend. Only cash flows are given and they are telling us to give recommendation. We will try it out. I am first doing it of project X. My cash flows are 50,000, 60,000 and 70,000 with a probability of 0.30, 0.30, 0.40. My expected value, it is expected value of X. Symbolically it is written as this, or it is X bar. It is the sigma xi pi, just multiplication of this three. So 50,000 into 0.3 is equal to m plus, 60,000 into 0.3 is equal to m plus, and 70,000 into 0.4 is equal to m plus. MRC is 61,000. 61,000 rupees cash flow is my average. Expected net cash outflow of each project. So this is answer number A. Variance of each project. How to find out variance? Variance is standard deviation square. I will be using this formula, sigma x minus x bar whole square into P. Sir, why not under root? Because it is variance and not standard deviation. I will be directly finding out in my calculator sigma x minus x bar whole square into P. If you don't understand, try to concentrate. 50,000 x minus 61,000 x bar into is equal to square multiplied by 0.30 is equal to m plus. It is coming a huge answer, yes. 60,000 minus 61,000 multiplied by is equal to multiplied by 0.30 is equal to m plus. 70,000 minus 61,000 multiplied by is equal to multiplied by 0.4 is equal to m plus. MRC is 6 crore 90 lakhs. And this is my answer of variance, 6 crore 90 lakhs, which is my B answer. Standard deviation, C answer. Standard deviation is under root variance. So it is under root 6 crore 90 lakhs. It is 6 crore 90 lakhs. So 6 crore 90, that is 690 lakhs under root. This 26 lakh 26,785. Let me do it. 6 crore 90 lakhs is variance, right? So 6 crore 90 lakhs. 8306.62 is the standard deviation of this project. D. Coefficient of variance is nothing but standard deviation divided by x bar, which is 8306.62 divided by x bar is 61,000, which will be equal to 8306.62 divided by 61,000, 0.1362. This I have done of project X. I will have to repeat it for project Y. One 30, 110, 90. This is Y. Probability is 0.2, 0.3, 0.5. Y bar or expected value or answer A, 1,30,000 into 0.2 is equal to M plus 1,10,000 into 0.3 is equal to M plus 90,000 into 0.5 is equal to M plus. MRC is 1,04,000. I will be finding out variance by sigma x minus x bar whole square into P. So it will be 1,30,000 minus 1,04,000 into is equal to multiplied by 0.2 is equal to M plus 1,10,000 minus 1,04,000 multiplied by is equal to multiplied by 0.3 is equal to M plus 90,000 minus 1,04,000 multiplied by is equal to multiplied by 0.5 is equal to M plus. MRC is 24 crore 40 lakhs. 24 crore 40 rupees, which is nothing but variance, which I have found out by sigma x minus x bar whole square into P. Standard deviation under root 24 crore 40 lakhs. So 24 crore 40 lakhs under root 15,620. And coefficient of variance, standard deviation upon y bar, 15,620 divided by 1,04,000. (0.1502). I'm just making a comparative presentation of X and Y. Standard deviation of X is 8306 and standard deviation of Y is 15,620. So if you just watch this figure, let me write down 8307 approximately. If you compare these two figures, you will feel that project Y is more risky. Now here we are only measuring risk, we are not measuring any return. But if you see coefficient of variance, this will be 0.1502 and this will be 0.1362. 0.1362. As far as the total risk is concerned, project X is less risky. As far as coefficient of variation is concerned, project X is less risky. You should select a project which is less risky. Please try to understand, whenever you give advice to management, be very careful what you are writing it down. Don't advise management to take project X. Advise this. Advice to project X is less risky as compared to project Y. Your advice should be absolutely correct. That does not mean you will be selecting project Y. You will have to still see the cost of project Y. You will have to see other variables of project Y. Yes, by these two figures you can determine that, you can determine that project X is less risky as compared to project Y. This gives you idea of total risk. This gives you idea of comparative risk to your cash flow. I'll tell you what is a 0.13. In project X, there is a 0.13 risk for every 1 rupee of cash flow. In project Y, there is 0.15 risk for every 1 rupee of cash flow. If you want to find it out in percentage, you can multiply this by 100. But no need to do it. You can directly compare it with 1. Is it all right? So compare these two figures and you will be getting an answer which project is more risky. We are incorporating risk into capital budgeting, and this is nothing but incorporation of risk into capital budgeting. We have not incorporated actually, we have found out separately. This is measurement of, and see my advice also, it is absolutely logical. Project X is less risky as compared to project Y. That's it. And the advice, don't advise to take up project